Good morning. Let us see the profitability ratios in detail. Profitability of financial performance is mainly summarized in the statement of profit and loss. Profitability ratios are calculated to analyze the earning capacity of the business, which is the outcome of utilization of resources employed in the business. There is a close relationship between the profit and the efficiency with which the resources employed in the business are utilized. The various ratios which are commonly used to analyze the profitability ratios are gross profit ratio, operating ratio, net profit ratios. Profitability ratios are matrices that access a company's ability to generate income relative to its revenue, operating costs, balance sheet, assets, or shareholders' equity. This ratio shows how efficiently a company generates profits and value for shareholders. Higher ratio results are often more favorable, but ratios provide much more information when compared to results of similar companies, the company's own historical performance, or the industry average. Profitability ratios compare income statement account and categories to show a company's ability to generate profit from its operations. This ratio focuses on a company's return on investment in inventory and other assets. These ratios basically show how well companies can achieve profits from their operations. Investors and creditors can use it to judge a company's return on investment based on its relative level of resources and assets. It can be used to judge whether companies are making enough operational profit from their assets. It relates to efficiency ratio because they show how well companies are using their assets to generate the profits. For most profitability ratios, having a higher value relative to a competitor's ratio or relative to the same ratio from a previous period indicates that the company is doing well. Profitability ratios are most useful when compared to similar companies, the company's own history or average ratios, or for the company's industry. The definitions: the ratio that measures the capacity of a firm to generate profits out of the expenses and other costs incurred over a period are called the profitability ratios. The profitability ratios measure the overall performance of the company in terms of the total revenue generated from its operations. It would not be useful to compare a retailer's fourth quarter gross profit margin with its first quarter gross profit margin because they are not directly comparable. Comparing a retailer's fourth quarter profit margin with its fourth quarter profit margin from the previous year would be far more informative. Different profit margins are used to measure a company's profitability at various cost levels, including gross margin, operating margin, pre tax margin, and net profit margin. Types of profitability ratios: gross profit ratio, operating profit ratio, net profit ratio, return on investment, return on equity, return on capital employed. These are the different types of profitability ratios. Let us see the different ratios in detail. Some of the uses of profitability ratios: to the business sector to know about the current position, it compares with the other company, and also to find out in every sector of the company to develop the planning and capital movements of the company, minimize the risks. So before going in detail, we should know the uses of profitability ratios, which gives a strong development for all the companies. Gross profit ratio. Gross profit ratio looks at a cost of goods sold as a percentage of sales. This ratio looks at how well a company controls the cost of its inventory and the manufacturing of its products, and it passes on the cost to its customers. The larger the gross profit ratio is, the better for the company. Gross profit ratio as a percentage of revenue from operations is computed to have an idea about gross margin. It indicates gross margin on products sold. It also indicates the margin available to cover operating expenses, non operating expenses, etc. Change in gross profit ratio may be due to change in selling price or cost of revenue from operations, or a combination of both. A low ratio may indicate unfavorable purchase and sales policy. Higher gross profit ratio is always a good sign. What are the benefits of gross profit ratio? It measures a company's manufacturing and distribution efficiency during the production process. Investors use a gross profit ratio to compare the companies in the same industry and also in different industries to determine what are the most profitable. A company that boasts a higher gross ratio, that is, competitors and industry, is more efficient. Gross profit ratio formula: gross profit divided by net sales into 100. So, what is gross profit? Gross profit is equal to net sales minus cost of goods sold. Cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock. So, this is a formula to find out the gross profit ratio. Cost of goods formula is here the opening stock plus purchases plus direct expenses minus closing stock. So, closing stock has to be subtracted with this opening stock, purchases plus direct expenses. So, this is what cost of goods sold. Let us see a problem under gross profit ratio. From the following details of a business concern, ascertain gross profit ratio. So here the 2 years are given. They are asking you to find it out 2008 as well as the 2009 gross profit ratio. So the sales for 2008 is 1,20,000 and in 2009 it is 1,40,000. Gross profit is 40,000 in 2008 and 60,000 in 2009. So you have to apply the formula. So gross profit ratio is equal to gross profit divided by net sales into 100. So gross profit for the year 2008, we know that it is 40,000 and the net sales is 1,20,000 into 100. Apply the formula and here you are getting 33.33%. Let us come for 2009. Gross profit ratio for the year 2009 is equal to gross profit there it is 60,000 and the net sales is 1,60,000. So when you're dividing it, 60,000 divided by 1,60,000 into 100, you're getting 37.5%. So gross profit ratio for 2008 is 33.33%. Gross profit ratio for the year 2009 is 37.5%. So 33.33% is for 2008 and 37.5% is for 2009. Let us see one more example. Total sales is given as 5,20,000 in 2008. Sales return is given as 20,000 and cost of goods sold is 4 lakhs. Calculate the gross profit ratio. The formula for finding out the gross profit is equal to total sales minus sales return minus cost of goods sold. So here the total sales 5,20,000, sales returns 20,000 and cost of goods sold 4 lakhs. Here we are getting 1 lakh. How to find out the net sales? Net sales here is equal to total sales minus sales returns. That is the formula. So here that is rupees 5,20,000 minus 20,000 is equal to 5 lakhs. So this is what the net sales, which is giving you as 5 lakhs. On the next one, gross profit ratio, we have to apply the formula gross profit divided by net sales into 100. So gross profit already we know it is 1 lakh divided by net sales is 5 lakh into 100, which gives you 20%. This is the way we have to find out the gross profit ratio. Operating ratio. What is operating ratio? It is computed to analyze the cost of operations in relation to revenue from operations. Operating expenses include office expenses, administrative expenses, selling expenses, distribution expenses, depreciation, and employee benefit expenses, etc. Cost of operation is determined by excluding the non operating incomes and expenses such as loss on sale of assets, interest paid, dividend received, loss by fire, speculation gain, and so on. Let us see the sums in detail. Here the operating ratio is computed to establish relationship between the operating cost and net sales. This is closely related to the ratio of operating profit to net sales. Formula for finding out the operating ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100. Operating ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100, or operating ratio is equal to operating cost divided by net sales into 100. So in both the formulas, any one formula is applicable. Both also you can use it at the same time, which gives you the correct solution. Components of operating ratio. Cost of sales includes direct cost of goods sold as well as other operating expenses, administration, selling, and distribution expenses which have matching relationship with sales. Financial charges such as interest, provision for taxation, etc., are generally excluded from operating expenses. What is the objective of calculating the operating ratios? Operating ratio is a test of the operational efficiency of the business. It shows the percentage of sales which is observed by the cost of sales and operating expenses. Lower operating ratio shows higher operating profit. An operating ratio ranging between 75% and 80% is generally considered as standard for most manufacturing concerns. This ratio is considered to be a yardstick of operating efficiency, but it should be used cautiously because it may be affected by a number of uncontrollable factors beyond the control of the firm. So, this is used as a measurable for operating efficiency. In finance, the operating ratio is a company's operating expenses as a percentage of revenue. This financial revenue is most commonly used for industries which require a large percentage of revenues to maintain operations. The operating ratios can be used to determine the efficiency of a company's management, as we have seen it earlier, by comparing the operating expenses to net sales. It is calculated by dividing the operating expenses by the net sales. The smaller the ratio, the greater the organization's ability to generate profit. The ratio does not factor in expansion or debt repayment. Alternatively, it may be expressed as a ratio of sales to cost. In such a case, a higher ratio indicates a better ability to generate revenue. Let us see some problems in operating ratios. From the following details, calculate operating ratio. The cost of goods sold is 6 lakhs. Operating expenses is 40,000. Sales is 8 lakh 20,000 and sales returns is 20,000. So we have to apply the formula here. Net sales is equal to total sales minus sales returns. So total sales is 8 lakh 20,000 minus 20,000, which will give you 8 lakhs. Operating ratio is equal to cost of goods sold plus operating expenses. That is what operating expenses. We have to find it out. So here you're getting 6 lakhs plus 40,000 divided by 8 lakhs into 100. That will give you 6 lakh 40,000 divided by 8 lakhs into 100, which gives you 80%. While finding out the operating ratios, cost of goods sold is already given, which is given as 6 lakhs, and operating expenses, which is given as 40,000. So both you have to add to get 6 lakh 40,000 divided by 8 lakhs into 100, which gives you 80%. The significance of this is computed to express cost of operations excluding financial charges in relation to revenue from operations. It is operating profit ratio. It helps to analyze the performance of business, which I told you earlier, and throws light in the operational efficiency of a business. Low operating ratio is a very healthy sign. Operating ratio is computed by dividing the operating expenses of a particular period by net sales made during that period. It is expressed as percentage. The basic components of the formula are operating cost and net sales. Operating cost is equal to the cost of goods sold plus operating expenses, which I already said. So the net operating expenses such as interest charges, taxes, etc. are excluded from the computations.